Today, I'm going to be talking as best as I can. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do currently hold a long position in Enviva, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. All right, so Enviva reported their first quarter results and they changed their capital allocation priorities. That is their euphemism for cutting their dividend down to zero. Now, this is huge news. This is a large portion, I assume. I think most people would agree as to why the stock dropped a ton. Dropped from the mid-low 20s down to single digits now. It's trading at $8 and something. So hopefully, probably pretty obvious. Why did they do this? Let's talk through this a little bit today. It is a big 180. The company had made a big, I shouldn't say made a big deal, but they made it clear that they intended to keep paying this dividend. They even, recently did pay it, for the Q1. And, I had a prior video penciling through the numbers, and yes, things were tight, and they would have to they would be borrowing money in order to pay the dividend for the next year, maybe 2 years. But given their growth that they had, it would have been possible for them to do that and then eventually dig themselves out of that hole with pretty much what's already in their control. Now, here's what they said in Q1 as to, kind of what changed. They didn't actually even have that much in this particular release, which was frustrating. They basically just said, well, we reevaluated and determined it was better for us to not pay the dividend, and maybe we'll buy back some shares instead if we want to. Which who knows? That remains to be seen. They did this somewhere in here. They did authorize up to $100 million of shares to share repurchases in the open market, but you have to really go to the earnings call to see what it is. What was their explanation? Why did they cut the dividend? What changed just from a month ago? And you read through this, and they basically cited costs that were within their control, and it's kind of weird. They placed the blame, if you read through this, all on their operations folks. Right, so let me find this. They made some changes to the operations team. I don't think this transcript got it quite right, but they basically said in Q1 and in recent past, there were their operations leadership. They prioritized production over cost management, and they were basically just getting, I guess, wood pellets produced at whatever cost it took, and that basically led to two things. Number one, they had some additional unplanned repairs and maintenance because apparently, according to, if you believe what they said in the transcript, folks were not doing the proper maintenance, and so that caused, some extra stuff. Who knows? They didn't give a lot of transparency, and it's hard, because that would be pretty deep in the business. But they said, hey, we had $10 million unplanned repairs and maintenance in Q1, which is a lot considering their maintenance capex for the whole quarter, or sorry, for the whole year. I believe their guidance is $20 million per year. I could probably go check. Maintenance. Yeah, maintenance capex for existing asset footprint of approximately $20 million, right? And this is for the full year of 2023. So to have 10 million unplanned expenses in Q1 was very high. Now, that's, I would hope, not enough for them to cut the dividend, but I think it was that stacked with, they talked about having just cost overages, and they expected to be able to be driving down their costs, be driving up their margins, really, I should say, into Q1 and beyond throughout this entire year, right? That if you looked at their prior investor presentation, they did have, they spelled out exactly where they believe they were going to get all the incremental increased EBITDA, and that was one of them. They had some reduction in their costs for the existing production they already had, and they basically said, we didn't see any of that. They talked about, one of the analysts in the call asked them about this somewhere down here, and they talked about, well, we thought it was due to the polar vortex, but actually that just, that was kind of a red herring. It doesn't really capture here, but he basically said that the polar vortex basically masked what were actually our operational challenges. And so they think that they're going to be able to do this. The CEO basically said that he is himself overseeing a couple of the plants that were not performing. And they fired their operations folks. I think I glossed over it up here, but they got rid of two operations. Two of their they I think this captured wrong. They exited two of their senior operations executives. And they even filed the 8K about one of these, Edward Royal Smith, the executive vice president of operations, separated from the company pursuant to the notice he was given by the company on May 1st. So this really reads to me like they place the blame at some of the operations leadership, two folks here, and that they believe they're going to be able to actually make things, capture some of those cost improvements. But they also revised their guidance for the full year down, and they had another one that they talked about, two causes. There was just basically, I guess the two causes were the unplanned repairs and maintenance of $10 million. And then they said there's going to be $40-50 million throughout the course of the year where they're just not getting these cost savings that they thought they were going to get this year. And so, really a lot of this comes down to, do you believe they're going to be able to do that? If so, I think Enviva still has some significant upside. But if not, if I updated my prior to try to keep this, a little bit brief, you can look through the Q1 numbers yourself. Well, I'll look at the Q1 numbers real quickly. They ended up only reporting adjusted EBITDA of $3.4 million, which was down from the forecast of, I think, somewhere around the order of $30 or $40 million. And again, the biggest difference here, in fact, maybe it's even easier just to go to their actual Q1 results and just show this, right? So if we go to Q1 of 2022, revenue 233, Q1 2023 revenue 269. That is up. Well, I guess gross margin might be the bigger thing to look at. If their gross margin per ton, where their gross margin per ton a year ago in first quarter of 2022 was $46. In 2023, you see it's down, and this is again excluding that the deferred gross margin transaction thing. That's that weird accounting thing. Let's just forget about that for today. If you want to watch my prior video on Enviva, I talk through all of that, or you can read up on it. But basically, their margin, dollars per metric ton, dropped from 46 a year ago to 19, just under $20 now. And so that was huge. Just a huge drop there. And they attributed it basically just to cost. They said, hey, our revenue is up, our revenue grew, and this is just costs out the plant. And so they went a little bit deeper on the earnings call, and they talked about basically, we've got more contract labor that we don't need anymore. They said as of this point, we're fully staffed. We didn't need them. People were maybe doing overtime. They talk a little about overtime here. Overtime, maybe they split it into two words. Yeah, not that. People were doing extra overtime, even though they're fully staffed. They didn't really need to be doing that anymore. So I think there's some good. I think this was really in the context of somebody asking, hey, are those cost reductions actually in your control? Because it's not. We don't have enough transparency from the outside to really believe you. I'm paraphrasing here, but that was kind of the question. And they said, yeah, like these are very, very simple things. We just need to actually pay attention and do it. To just have the right level of staffing and don't have overtime. Don't be paying for extra contract labor as well. So I also updated this is my projection for, again, this is like napkin math, but based off of their remaining operations in 2023 and then 2024 and 2025, again, sort of going on the increased production capacity that we see if we assume they are able to actually ramp production as they're building these plants, and also they can get their costs under control, sort of as they're projecting here, and then capture some of that savings that they thought they were going to be able to do this year, and project that out across all of these new plants. Which again, I think is reasonable, right? If they're able to implement new processes, new controls for these things, it makes sense, right? This isn't rocket science. Again, if you believe management, then I think reasonable targets for adjusted EBITDA 2023 for the remainder of 2023, $200 million, sorry. 2024, more like 320. This was down from my prior estimate based off of the company's guidance of about 380, and then figure in 2025 more like 400. $400 million in EBITDA. And again, that is down from, I think, 480 was the prior guidance from the company. They didn't provide these. These are me sort of adjusting some numbers down, doing a reasonable guess, an educated guess here. If we do that, and then we also look at I'm tracking the change given those EBITDA numbers, the cash interest that they're going to have to pay on their balance sheet, maintenance CapEx, I just put in 20 for this year and then 30 for the next 2 years and $30 million. And then we look at where they're going to get their money to build some of these plants. They're going to issue some bonds, spend down the restricted cash they already have from issuing bonds, and they're going to partially draw down the revolver, right? And so if I look at this, I think this year, even without paying dividends, right, I put $0 for dividends paid, and I also didn't assume any share buyback. So if they actually buy back shares, that will be, more cash out, but also less shares outstanding. So, as an investor, you can make up your own mind if you think that's a good idea for them to do or not. But just looking at the operation of the company and the balance sheet, throughout 2023, I think they're going to end up drawing, with my rough model here, they would draw down from the revolver of another $44 million throughout this year. So they would actually still be net negative for the year in terms of cash. This assumes that they spend all the restricted cash they have right now. They don't issue any of the bonds for the Mississippi plant until next year. So we do that. They end the year with about $200 million borrowed under the revolving credit facility, and they've got all of this, existing debt. Then in 2023, by the end of 2023, they're going to issue these bonds. Things are going to flip. If they're able to issue these bonds, they'll be able to pay for all of their growth capex, and because of they're going to have a little bit of earnings after all of that, they'll actually will pay back the revolver with some of those bond issuances, or maybe pay the plant so that they can then use their earnings from operations to actually pay down the revolver, right? So it's not necessarily going to be taking the money from here and putting it over there, but the net effect is that's what it's going to be. And then they will end up, I think, paying down the revolver entirely and actually building up a tiny bit of cash, which should get them by 2025 to the point where they can actually, have some real cash in the bank. And again, I didn't look at when all of these, that a couple things had a term loan that might be due at some point along the way. I'm not quite sure. So maybe they pay back the term loan and still have some outstanding borrowing on the credit facility, the revolver. I didn't look in those details, so this is one place where it could be inaccurate. I was trying to just get the rough picture of how things look and where the overall trend. But the overall trend, I think, is good. If if things shake out this way by the end of 2025, things could be looking quite well. I actually, if we, let's say, just make the change here and assume that they would pay off, take that, $295 million, pay off some debt. Let's say they pay off here, I'll just take it off right here, even though I know this isn't what they're going to do. So subtract off the 295 to make our number go down. And then if we look at this, we're looking at their future EV to EBITDA multiples. Figure they have 70 million shares outstanding. Right now they have 67. Assume they don't try to raise capital, but they issue some to management. And let's say they get to forward EBITDA of $480 million. That's if they just got the same. That's what their original projection, I think, was for 2025. So if we take those numbers, maybe that's too optimistic. Maybe I should adjust it down to 400 or even lower. But if we take these numbers, what I think is, let's say, a reasonable but bullish case for Enviva, by the end of 2025, we could be looking at, some multiples here. If you want to value the company off their EV to EBITDA, even what I think is a fairly low EV to EBITDA multiple would have a share price of $17. Very quickly that number can go up more. You'd think they could get to 10. That's back to $51 per share. Again, this is assuming no dividends paid. So, this is just the way I'm sort of thinking about the stock. I do think there is one huge risk that exists now that didn't exist before, and that is they could take the company back private, right? The share price is down. I think management already owns a lot of shares. That's a bigger risk at this point than it was before, because it wouldn't cost them that much. And, as of right now, being able to, be publicly traded and access the markets to raise capital is really not something I assume they're looking at doing right now, given that the stock is trading where it is. So I actually think that's a material risk. It's something that we shouldn't ignore if you are invested in the company, but that's a risk you take pretty much in most investments where management owns a good chunk of the company. So anyways, that's how I'm thinking about it. I am still holding my shares. I am contemplating buying more at this point. I was originally buying this for the dividend. I had a small position knowing that the dividend was risky. And I walked through the numbers last time where I knew they would have to be borrowing to pay it out for at least the next year or two. And obviously that's a risky position. So the fact that they cut it to zero is a little bit surprising to me. With all the shares that management owns, I kind of thought they liked paying themselves. But hi James, I see James hopped on. James says considering buying more. I don't know if you're saying that for me or for you. Yeah, I am considering buying more. Actually, I don't have a lot of money laying around right now to invest. But yes, this is, I think, fairly. It's attractive at this point, right? Because nothing huge fundamentally changed with the company, right? Not paying the dividend, that's, not fun as an investor, especially not fun if you were expecting to have that income. But at the same time, if you instead forget about it as a dividend company, just look at it as, just we want to value the future earnings as a growth stock effectively, because that's kind of what they're looking at now. They have been building these plants. They have been trying to grow their production. It seems like if you believe that they can do those cost reductions at all, seems like there's a pretty good margin of safety at this level. Again, not financial advice. I am considering buying more shares. Haven't pulled the trigger yet. If the stock keeps trading in this range for a while, I might consider, buying some like out of the money calls on this, like long-term calls, because I think, either they're going to be able to actually reduce these costs, and we'll start to see that in 2023, 2024. And then, especially in 2024 and 2025, we'll start to really see the, increased production and what their cost profile looks like. And if they're able to, widen those margins per metric ton with the increased production, those numbers are going to look a lot better. And so, I think that's something I've been considering. James says, management didn't do a great job explaining the difference between reaffirming guidance at Investor Day in February to miss and guide down earnings. Yeah, and I think it was even later than February. I think they were even, if I recall correctly, they put out a lot of this stuff in March and maybe even April. I can't recall. But yeah, where they were saying, this is our plan. We know what we're going to have to, borrow down on our revolver, but we've got a lot of liquidity. We just bought more share, right? That when they did that insider transaction to buy more shares, they gave money to the company effectively, in return for shares. But, they're saying, hey, look, we've got more liquidity. We've got our plan for the next couple of years. We think we're going to be good. They even said they were going to have to access the capital markets. And so at that point, you can basically say, who cares, right? We know we're going to pay out our dividends. We're going to have a plan for being able to, do that, use our revolver as we need it. And we'll, we see the light at the end of the tunnel. We see the production increasing and us being able to pay this off in 2025 and 2026. They keep repeating 2026. They're $500 million in adjusted EBITDA. The numbers worked out. That was one of my prior videos. I went through it, and to me, unless I'm missing something, the numbers worked out on that plan. Clearly, it's not inaccurate for them to just frame this and say, they changed their capital allocation priority. I mean, they did. They changed their priority. They're no longer prioritizing the dividend, even though they could have. But yes, you hit the nail on the head there. Yeah, sorry, I'm being a bit long-winded, but you hit the nail on the head that they didn't really explain why did they decide to reprioritize now. They give a very, very weak explanation of, well, it wasn't really until we kind of closed the books on March and April that we really saw where we were at. And then we decided to make a change, but I don't know. It's not super. I agree. It's not super compelling. So we'll see. And I think management did lose some trust because of that. That's partially reflected in the stock right now, where you can't trust management to do what they said they were going to do a month ago when nothing huge and fundamental has changed. Yeah, it adds more risk to the future. So, but great comment. I totally agree. All right, I am going to hop off. That was already fairly long, 20 minutes. Thank you, James, for hopping on the stream. Thank you, anyone else who's there. who didn't pop in the chat but is watching. Really appreciate it. Have a good one.